Hey everyone, Nick here. Let's define options. They're a mysterious, very mysterious thing. I will use plain simple English. I will use Nick Logic. I will skip a whole bunch of junk. You can go and study options the way they describe them in books. I'm just offering my own spin on things, and it is definitely not Wall Street's definition. So, first and foremost, this is a table of options. I picked Apple randomly. The point in time doesn't really matter. It's always the same thing. So it does have monthly options. These are the white things, and they extend out to out years. The long dated options, they call them leaps, just for terms. And we also have some weeklies, shorter term. So we have one that expires next week, and it would have 7 days on the clock. One that expires a month out, 49 days on the clock, a little more. And then we have two sides. We have call options and put options. So this side are puts, this side are calls. I will have separate videos explaining what each is and how it's getting used. But now we're talking options in general and what they mean. Not what they mean, like some of the few things around them. First, they are contracts. So like any contract, it has a limit, a term, time, span, whatever, and we just talked about it. Some are 49 days, some are shorter, some are longer. So there's a time limit on this contract. There's also a buyer and a seller. So you've heard CNBC sometimes say they are buying the 130 call in Apple for May. Well, that's half the story because for every buyer, there's somebody else selling it. So I don't want to side with one person or the other because I don't know who's the buyer, who's the seller. So why am I believing the buyer is smarter than the seller if I wanted to chase that idea? So there is a buyer and there is a seller. It works the same on the puts. If somebody's buying a put, somebody's selling that put. They don't come off the shelf. So there are two sides to every opinion. And another thing you would hear if you actually, or read, if you pick up a book about options, I bet you in the first paragraph or first chapter, there will be a statement that says, most options expire worthless, which is maybe statistically true. I never measured them, but I will take them to their word. But if that's correct, then then this is where the danger part comes in. You've also heard that options are very dangerous, more dangerous than stocks. That's wrong. They're not more dangerous than stocks. They can be, but they're not by definition. But since they do expire worthless more often than not, then that makes me want to be very picky with the ones I buy. And if I'm very picky, you eliminate a lot of the danger right away. The danger comes because I can buy a whole bunch of options, and then if they all expire worthless, then I'm just wasting my money type of a deal. So that's the danger part, in my opinion. So being very picky is important. What does that mean, really? If I wanted to chase an option strategy, I should make sure that there is confirmation, a high degree of success. And that comes in the next step. So what is all that Greek stuff they talk about? Vega, delta, gamma, theta. So I'm going to speak about the couple of things that I use, and the rest is too wonky for this top line view of options, so we will avoid it. First is theta. That's a fancy word, a fancy way of saying time. The minute I buy an option, put or calls, doesn't matter. Time is my enemy. I want something to happen within the allotted time frame, right? There's a clock for a reason. So tick tock, theta burn. You want that thing to happen. Theta burn meaning I have less time now for me to be right. And the less time I have, the cheaper the option, the more money I'm losing. I would need price action to happen in my favor for me to lose, to retain or make money on that option. So the theta, that's time. Delta is basically, I use it for gauging my odds. What? There is gambling here? Of course. It's odds. Everything is odds. When I buy shares of a stock, I have a 50-50 chance of being right. I can do homework and skew my odds that way in my head, but it doesn't change the fact that the stock price can go up or the stock price can go down. Same with the options. So at this point in time, it happens to be Apple at 123, which is right here between 120 and 125. It's 123. So if I look at the delta, which I have a column for it right there, it should be about 0.5, 0.4 to 0.5, anything around current price. So we can see here it is 0.5 and this one is 0.4. So it's 0.45, perfect. And the minus sign doesn't matter, that goes with all the puts. So this is my odds. So this is 50-50, you say? That's basically what it's saying, 0.5 delta. So let's see how we can verbalize this delta differently. All right, so what are the odds of Apple being at 100 in the next 49 days according to this table? Not very good. Look how low the delta is. The delta falls the further away I go. So if these are lottery tickets, here I have high odds, 50-50. Here I have low odds. There's a 95 to 93% chance of me not winning the lotto if I buy this ticket. Same on the delta on the call side. I have a column for that. 50-50 here. If I go up, hey, what are the odds Apple will be 150 in the next 49 days? Be very, very tiny. There's same odds as the other one, the 100. So these are losing lottery tickets if I buy them. All right, that's why they're cheap, 40 cents versus $4. This one is $4. This one's 40 cents because it has low odds if I'm buying. See what I mean? So the delta part is useful to me because it helps me gauge my odds of success. Okay, so what else on this table that we need to know about options? Open interest. This is the column that by the way, there are dozens of other columns that I choose not to look at. Again, you can go take a course on the specifics of details and how they build them, but it's not practical for me. So this is all I need to trade my options. Open interest are basically the actual positions that are currently for this contract. So when we woke up on that day, these were the positions. So what the heck is volume? Well, on that day, after we woke up, that's what happened. This number does not change until the next day. Nobody reports this dynamically. It's a static number refreshed overnight. So we woke up having all these positions. We traded. The next day, we will wake up having different numbers here, and this resets to 0. So based on what happened here, this will change. Same on this side as well. Open interest in the calls, what happened during the day. So let's recap here. We have what are options? They're basically contracts that have time limits, and they have a buyer and a seller. They also have different levels I can buy at, which is each level has a different odds of success or failure, and that column helps us gauge roughly what that is. As far as theta, that's the time limit. 49 days, the longer, the more expensive. But as soon as I buy it, time is my enemy. And the buyer of the options is in control, basically. They're driving the bus because there is a seller on the other end. We'll talk about that in different videos. So what I don't do with options is I don't start buying left and right without real purpose. And I should stop myself out. Options move very fast, so a mistake could become big. The repercussions could become big very quickly. So I should be picky with my trades, right? If I'm using options to trade, so I don't take risk more than I can afford to lose. That's for starters. I don't start buying hundreds of dollars, thousands of dollars, just because I have a hunch. I should be very methodical with my trades. Options are used to protect, which in that case, I'm not looking to make money. Its job is to die, and basically like when I buy insurance on my car. Then, I don't wake up every day saying, I wasted my insurance premiums. Well, I wasted it. That's because that's a good thing because I didn't crash my car. So, but some people use options to actually short stocks, and that would be where I have to be picky and have good technical support for that. So What I don't do with options personally, other people do, not for me. I never, and this is me telling any friend I have, sell naked calls. Because just like regular shorting stocks, I don't do that. Because as soon as I sell a stock short or sell a naked call, it's the same thing, similar. I lose control completely because the losses are unlimited, can be unlimited. I can't quantify the losses because I don't know what the stock price is going to do. A perfect example, if you remember what happened with GameStop. The stock went ballistic out of nowhere, and there were people that lost their entire nest egg because of it. If I'm short that stock, just happened to be short that stock, and boom, that thing happens out of the blue. Nobody saw it coming. But if I don't cover right away, and sometimes it's impossible, it's very, very painful. When I buy a stock, when I buy an option, my maximum loss is set. It's 100%. I can lose my money for that trade. When I sell a stock short, or when I sell a call naked in a stock or an index, I am opening unlimited risk, potentially. I don't like that. So I never sell naked calls. Selling naked puts is different, but that's a different video. Okay, so again, we can recap. Oh, you want to see them in action? So, all right. So here's how I trade an option. I can go in and I choose the counts. And in this case, I would be buying this. This is not a trade alert. This is just a visual representation of how I would place an options trade. I clicked on it, a window came up, I said give me one. Why just one? Because one represents 100 shares. So this one shows $1.30. If I go to finish the order, it's $130 out of my pocket. So that means it multiplied the 100 shares times the $1.30. So if I choose another one, it'll be simple math. But if I was buying this one, it should be $2.30, and this hasn't changed. Bug! E-Trade, it's full of bugs. But it's a decent way to structure trades, a platform. It's one contract, 100 shares. Therefore, whatever value I see here, I have to multiply by 100 at the final event. So if I'm buying this leg, it's $230. This one is $400. This one is only $78. This one is only $40, $37. So that's how I would buy a put. How do I buy a call? Similarly, I go here and I say 1, and that would be the call I'm buying. Buying a call for $154. Why $154? Because it's $1.54. Again, it's showing the wrong value here. That's bizarre. Okay, there you go. Live TV, folks. That's it. This is the simplistic way of looking at options. So could I have chosen a different stock? Absolutely. If I go to Facebook, it would have a similar structure, different contracts sometimes. They don't always have the same weeks. They definitely have different values based on how volatile the stock is. How do I gauge that? This column right here has a volatility gauge, kind of like a mini VIX inside the stock itself. The higher, the more nervous. For GameStop, this hit 1,000, I think. I saw it at 900. I'm pretty sure it went higher than that, which is unheard of. The value here changes based on the price of the stock also. Like this is a more expensive stock, not value-wise, just higher ticket stock. Then the values are higher. We're no longer talking $100 or $200. Let me illustrate that. I'll go to Google. It's a $2,000 share, and it's 80. So wrap your mind around this. $7,600 to buy one of these for 49 days because it's a high ticket stock price. Because it represents 100 shares, so it's a high ticket price. It's not that it's an expensive stock, like from a value perspective. Like, is it worth that much? No, we're talking high ticket. Like Amazon would be even higher. And these values should be higher. Look, 120, because it's 1,000 more per face value of the ticket. So if somebody is playing with, I'll choose Palantir. Palantir is $23 stock. It's almost as expensive as Apple, you say. What? But Apple is 100. Oh, look right. Implied volatility is more than double that of Apple. Apple's in the 30s. So the VIX for this, the nervousness for this stock is a lot higher than Apple. So the market evaluates it as a faster mover. Therefore, they want to collect more premium. So they assign it more premium. So this is an important metric, the implied volatility, because it explains why these values are higher than Apple. At $20, it shouldn't be as expensive as Apple, but there it is. So little nuances. So there are tons of ways to define the delta, the rate of change with $1 move, and theta and the vega and the gamma and all of these things. They're out there. You can spend days learning them. But these are the basics in plain, simple English, and they should help us get started on demystifying options. And I can't get it any more simpler than this. A bunch of contracts between a bunch of buyers and a bunch of sellers. How to use them, we'll have videos later about that. And they have term limits, and of course strike prices. Strike prices, that's what these are, levels. Pretty fun world to be in. Pretty treacherous if I start getting reckless. Responsible trading always is. Never take a risk I can't afford to lose. So if I shouldn't structure a trade that could blow me out. Breaking my heart is okay. Breaking my piggy bank, no bueno.